This is Nightly Business Report with Sue Herrera and Bill Griffin.
Historic vote. The 45th president of the United States is set to become the third ever impeached as House members spend much of this trading day debating the charges against him.
But amid the political drama, the Nasdaq closed at a record, and the Dow and S&P 500 sit near their all-time highs. Those stories and more tonight on Nightly Business Report for Wednesday, December 18th. Good evening, everyone, and welcome. Wall Street's attention was on Washington today as the House of Representatives moved to impeach President Donald Trump. Despite the historic day in our nation's capital, the major averages made just small moves, finishing at or near their all-time highs. Perhaps because, as one survey put it, investors have grown comfortable with a scenario in which the president is impeached and not convicted, as many believe will be the case. So here are the numbers. The Dow Jones Industrial Average fell 27 points to 28,239. The Nasdaq was up 4, closing at a record, and the S&P 500 was down 1.
Yes, political differences were definitely on full display in our nation's capital today. President Trump called the impeachment proceedings an assault on America, while House Speaker Nancy Pelosi said Democrats had no choice. Debate took up most of this day, and a vote is expected later this evening. Nearly all of the Democrats in the House are expected to support the two charges against the president. That would be abuse of power and obstruction of Congress, while nearly all Republicans are expected to vote against them. Will there be any impact on the economy or the stock market? Well, that's difficult to say. Following President Bill Clinton's impeachment roughly 20 years ago, stocks rallied. But that was more the result of economic conditions and the dot-com boom underway at that time. John Harwood is covering the story for us tonight from our nation's capital. What happens after this vote, John? What comes next?
Well, if we follow the usual course, the impeachment articles will go over to the Senate. The Senate will conduct a trial of some kind. Of course, there is a dispute between Democrats and Republicans over what form that trial will take, whether there'll be additional witnesses who have not testified so far. Some Democrats in the House, Bill, are even talking about withholding the articles so that there cannot be a quick vote to acquit President Trump that would allow him to go out and say, you see, I've been cleared of the charges. Not clear that that's the course they're going to take, but the consensus expectation is at some point it will get to the Senate and there will not be the 20 senators needed to join with Democrats to force the president out of office.
John, there's a new NBC News Wall Street Journal poll out asking whether President Trump should be impeached or removed. What are the results? What does it say?
Deadlocked, Sue, even 48% in favor, 48% opposed, which just shows that it is very difficult in a country this divided to attract many people from the other side to your point of view. 90% of Republicans opposed the impeachment and removal of President Trump. About 90% of Democrats do. Interestingly, in the poll, 75% of Americans say that Trump did something wrong. Even 45% of Republicans say that, but that doesn't mean all those people who did something wrong think it justifies his impeachment.
John Harwood in Washington. Thanks, John.
Over the past few days, we've been telling you about all of the reasons why stocks are at new highs. There's the trade truce with China, a neutral Fed, and the belief that global growth is finding its footing. But there are also new questions about whether global growth will soon pick up. Bob Pisani is at the New York Stock Exchange.
It was another quiet run-up to an almost record high, but the Dow and the S&P fell just short right at the close. The bulls have cheered greater clarity on their four biggest fears this year: trade wars, the Federal Reserve, no recession in the U.S. economy, and hopes for a bottoming in global growth. But that last point on global growth is still a little bit on the murky side. We're not quite sure. Shares of FedEx, for example, fell about 10% after the shipping giant delivered a big miss for the second quarter and cut its earnings outlook for 2020, citing higher costs and weaker global economic conditions, and the end of its delivery relationship with Amazon.com. CEO Fred Smith called the global growth story a tale of two economies. We have a stronger consumer economy, that's good news, and a still struggling manufacturing sector. He said growth appears to be bottoming at very low levels in Europe, and that China will likely keep slowing down in the beginning of next year and then see a pickup in the second half. Finally, Bank of America came out with its latest global fund managers survey. That was yesterday, and investor sentiment has turned decidedly more bullish. This is an indication that a lot of traders believe that the global economy is bottoming. Almost 70% of respondents said they're not expecting any recession in 2020. That's up, way up from just a month ago. For Nightly Business Report, I'm Bob Bassani at the New York Stock Exchange.
So will global growth be a headwind or a tailwind for the market next year? Joining us with his thoughts on that, Larry Adam is the Chief Investment Officer at Raymond James. Good to see you. Thanks for joining us tonight, Larry.
Good to see you, Bill.
What do you think? Tailwind, headwind next year?
Well, I think global growth is going to be a tailwind. I think when you look at what's happened, if we looked at last year at this point in time, it was a totally different story.
Right.
You only had about 15% of global central banks cutting rates. Today, about 65% of global central banks are actually cutting rates, and that tends to act with a lag. So as we get into next year, those should be very stimulative for growth. And then when you look at fiscal policy, we just got a deal for our budget here in the United States this past week, and that's calling for about a 3.5% increase in spending by our government. That should help growth, but more importantly, that's happening globally. Japan just had a $120 billion stimulus, and in fact, their government just raised their GDP forecast to 1.4 next year from 1.2.
Right.
And similar things are happening in Europe and China.
You also point to the U.S. consumer and specifically the job situation.
Well, the job situation continues to be very healthy. In fact, one of our indicators that we'd like to look at is withholding taxes, because every single week, if you own a business here in the United States, you have to collect the taxes and send it to the government. And right now, that is not only at an all-time record high, but it continues to grow at about a 5% rate, which means there's either more people working or they're getting paid more. But either way, the heart of the U.S. economy, the consumer, has more money to spend. So that's a big positive as we go into next year.
I'm going to be the wet blanket here. I get nervous when it sounds like we feel like we've figured things out completely. What could go wrong next year? What would keep you up?
Well, one thing that I think you mentioned it was that survey that we just heard from Merrill Lynch, and that is that everybody's on the same page.
Right.
And I think it's fine to run with the herd for a while, but the big trick is obviously when do you kind of pull away from the herd. I think we're still fine. One of the things that's very positive in my mind is that it is an election year, and two things happen in election years. Number one, it's very rare to go into a recession, and number two, it's rare that the equity markets have a sell-off in an election year. So because of that, I still feel pretty positive and good for this upcoming year.
Very good. Larry Adam with Raymond James. Again, thanks for joining us tonight, Larry.
Thank you very much.
Well, the housing market seems to be firing once again on all cylinders. As we reported, home builder sentiment is higher and construction is picking up. Today, you can add a new report that points to a strong 2020 for the industry. Here's Diana Olick.
A sharp jump in both housing starts and building permits recently, in addition to very strong buyer demand, could mean big results for builders next year. Fannie Mae is boosting its 2020 forecast, quote, significantly, thanks to stronger overall economic growth, specifically a robust labor market and increased consumer spending. Researchers at the mortgage giant predict housing starts will ramp up to 10% growth next year and top 1 million newly built homes in 2021. That would mark a post-recession high, but it's still far below the annual peak of about 1.7 million single-family starts in 2005 and the 1.2 million annual pace experienced in the late 90s. Single-family housing starts have been improving steadily since May. Still, researchers at Fannie Mae say it will likely take several years, even at a more robust pace, for new construction to address the existing pent-up demand for additional housing, as suggested by a still increasing share of 25 to 34-year-olds living at home with their parents. Mortgage applications to buy a new home are up double digits, but when you look at new home sales, they are still a much smaller share of overall sales than they have been historically.
The wild card, as always, will be price. If builders can pivot to more entry-level homes, they'll likely sell more homes. Right now, they're still in the higher price ranges, not exactly where the bulk of their demand lives. For Nightly Business Report, I'm Diana Olick in Washington.
We have a major merger to tell you about in the auto world tonight. Fiat Chrysler, the parent of Jeep and Ram, is getting together with French automaker PSA. That's the parent of Peugeot and Citroën. As Phil LeBeau reports, the combined company will sell more cars and trucks than General Motors.
The leaders of Fiat Chrysler and PSA have inked a deal creating a global auto giant with a huge presence in Europe and the U.S. It's a 50-50 merger with annual savings of $4.1 billion by combining resources. And they expect to do it without cutting jobs or closing plants. It still needs regulatory approval, which could take 12 to 15 months. But the CEO of PSA sees enormous potential putting 12 auto brands under one roof.
The brands carry the passion, the brands carry the history, and the brands carry the emotions. This is the reason why we consider that the brands will stay in their countries of origin.
That means FCA's U.S. headquarters outside Detroit won't move. And the two most important brands based here in the U.S., Ram and Jeep, will be a big part of the new company.
You can imagine a scenario where a very strong brand with very strong technology and deployment come together and significantly boost the performance of Jeep. So we're super excited about that.
Last year, FCA and PSA sold more than 8 million vehicles, making the combined company the world's fourth largest automaker, bigger than GM and Ford. But don't look for GM and Ford to follow Fiat Chrysler's lead and seek a major merger of their own. That's because both automakers are more focused on becoming leaner and more profitable. Phil LeBeau, Nightly Business Report, Chicago.
It is time to take a look at some of today's upgrades and downgrades. Delta was upgraded to buy from hold at Deutsche Bank. The analyst cites solid demand and an historically low stock valuation. The price target is $70. The stock fell a fraction to $58.58. Eli Lilly was upgraded to overweight from equal weight over at Morgan Stanley. The analyst cites the company's diabetes drug, saying it will have, quote, strong and durable sales. The price target is $150. The stock was up 3% to $129.48.
The Real was initiated with a buy rating at B. Riley in new coverage. The analyst there says the luxury goods consignment company is well positioned to take advantage of that growing part of the retail market right now. Price target, $23. The stock rose 1.5% today to $17.70. Halliburton was downgraded to market perform from outperform at BMO Capital. The analyst cited competitive pricing and a tepid recovery in the U.S. fracking industry right now. Price target, $23. That stock fell a fraction to $24.54.
Bernie Ebbers, remember him? He's the former CEO of WorldCom, who oversaw one of the biggest corporate scandals ever. Today, a judge ordered his early release, something we told you was being considered. Scott Cohn is at the courthouse in New York for us tonight.
He presided over one of the biggest corporate scandals in history, an $11 billion accounting fraud at WorldCom. And for that, Bernard Ebbers was sentenced back in 2005 to 25 years in prison. But now he will be released early after serving about 13 years of that sentence. A judge citing health concerns. He is now 78 years old, legally blind, and the 6-foot-tall former telecom cowboy has withered to 147 pounds.
He was in the hospital last week, released late last week. Last I've heard, he's now in a wheelchair, just continuing to decline physically and mentally. So he is not a well man.
His attorney noted that Ebbers has been in the hospital 3 times in the last 3 weeks. And he says that in essence, Bernie Ebbers has already served a life sentence.
I believe Mr. Ebbers has served a life sentence because his quality of life is now gone. The Bernie Ebbers that walked into prison in 2006 is not the Bernie Ebbers that exists today.
The government argued that essentially cutting Ebbers' sentence in half would send the wrong message to corporate America. Judge Valerie Caproni said she had heard from many victims who still have not bounced back from the WorldCom fraud, the company collapsing back in 2002. She said if keeping him in jail would give them their money back, it would be an easy decision, but that's not the case. Ebbers will now go back to Mississippi and live out the remaining days with his family. Many of his family members were in court for the decision and broke down in tears as the judge made her ruling. Scott Cohn for Nightly Business Report, New York.
Still ahead, Washington's latest push to try and lower drug prices. The Trump administration is pushing ahead with one measure that it says could lower the price of prescription drugs. The White House is issuing a proposed rule that would allow some medications to be imported from Canada. Bertha Coombs has the details.
The Trump administration is setting the stage for states like Florida to re-import lower-priced drugs legally from Canada. Governor Ron DeSantis helped convince President Trump to back the idea.
I've always said, there's no silver bullet with this, but this is a step that no one's been willing to take for almost 20 years. All the way back to 2003, you've had presidents of both parties, you've had secretaries of both parties, and yet until now we haven't done it.
Health and Human Services Secretary Alex Azar had been among those who'd argued against the safety and value of re-importing drugs for years, but says now the drug price environment is different.
There have always been questions about how effective it can be at lowering costs. Over time, the drug pricing marketplace has changed, and we've seen improvements to supply chain safety as well.
Under the administration's proposal, states working with wholesalers would apply to the FDA for approval to import certain brand name drugs from Canada, mostly in pill form. Low-cost generics and high-priced injectable drugs like insulin would not be included under the measure. The move would not create much of a dent for high-priced drugs to find their way back to the U.S.
It would be quicker to put drugs on a dog sled from Canada and point it toward Florida than it would be to get a drug through this new regulatory process.
It will take several months for a final rule to be implemented before the first states could apply for approval. And it's not clear the Canadian government will facilitate exports of drugs they've negotiated for.
We hope they'll work with us. I think they're obviously concerned about their own system.
What's more, analysts say drug makers would not be incentivized to produce more drugs to re-import at lower prices.
Manufacturers can control how much volume goes into Canada, so they're unlikely to dramatically increase the amount of drugs in Canada just to have them get shipped into the U.S. at lower costs than the cost of drugs in the U.S.
The administration admits it has no benchmark for just how much reimportation of drugs could save Americans, but say the president is committed to try. For Nightly Business Report, I'm Bertha Coombs.
Breakfast and pet food sales boost General Mills. And that's where we begin tonight's market focus, with the food conglomerate reporting its best cereal numbers globally in over a decade, plus an increase in sales in its Blue Buffalo pet food brand. That helped offset weakness in its snack food business. Bottom line, though, is General Mills topped earnings estimates overall, and the stock was up nearly 2% today to $53.18. California utility PG&E has won approval now from a federal bankruptcy judge on 2 settlements it reached, totaling more than $24 billion to compensate both the victims of 2 massive wildfires and the insurance companies that paid them. PG&E has already accepted responsibility for those wildfires. Shares rose more than 3.5% today to $11.31. Paychex is now adjusting its guidance upward for next year as the company now sees earnings growth of up to 10%. The company anticipates higher growth in its insurance services and its management solutions divisions. The stock fell a fraction today to $84.77.
Cigna will be selling its disability and accidental death insurance units to New York Life Insurance Company for more than $6 billion. The health insurer says it plans to use the deal proceeds to help reduce debt. New York Life says the agreement will add millions of customers to its business. Cigna shares gained nearly 2.5% to $198.20. WorldCom is reportedly looking to sell one of its wireless chip units. The Wall Street Journal reports that Credit Suisse is helping the chip maker in finding a buyer and that it could be worth $10 billion. Shares were up more than 1% to $327.44. And after the bell, Micron posted better than expected earnings and revenue thanks to strong demand for memory chips. Shares initially rose in after-hours trading and closed the regular session up a fraction to $53.04. All this week, we're getting you ready for the new year by bringing back some familiar Market Monitor guests. Tonight's guest has names of 3 quality growth stocks. Joining us is Alan Bond, co-portfolio manager at the Jensen Quality Growth Fund. Last time he was on, in February, he recommended United Technologies, which has risen 27%, Microsoft up 49%, and Pepsi, which has risen 22%. Welcome back, Alan. Nice to see you.
Thank you.
That's a nice scorecard to start out with. The stock that you like, we have three. First one is Intuit. Why do you like it?
Yeah, so Intuit is a financial management software company with brands such as TurboTax and QuickBooks. We think the strength of these brands and the high customer switching cost nature of the business model leads to a high degree of recurring revenue. We expect the company to grow due to new business formation and continued market share gains. And we've recently added to the position in our fund as the shares have pulled back from some strength earlier this year.
Your second stock is UPS. I'm interested in your comments on this company. You know, Federal Express yesterday talking about how it's still struggling in a global economy that it sees as slowing down. They've got higher costs. This doesn't seem to be bothering UPS right now. So I sort of naively ask you, gee, why do you like this one, Alan?
Yeah, so you know, UPS, global package delivery and supply chain management business that benefits from competitive advantages, including the strength of its brand and the integration of its global delivery network. The top line for UPS has been strong, and that's been driven by increasing volume with e-commerce shipments. The company has shown some stabilization and profitability. We think that can continue due to the investments the company's made to modernize their supply chain. So for us as long-term investors, we think this is a high-quality business that's trading at an attractive price right now.
Your next stock, my kids are very familiar with because they wear all their products, and that is VF Corporation.
Sure. Yeah. So VF is a global apparel manufacturer with a broad portfolio of brands, including North Face, Vans, and Timberland. We think the strength of these brands and the overall diversity of their revenue base is a real key differentiator for VF Corp. We think the company also has a very good financial position, and financial flexibility is very important to manage kind of the volatile nature of the retail environment. So this is another company we've added to. We think the shares are attractive, and we think this is a very high-quality business.
What's your outlook for next year? A lot of questions. You know, here we sit at all-time highs. A lot of bricks on the wall of worry have been put aside. So what do you think for 2020?
Yeah, right now to us, it feels like the market's really keyed in on confidence in whether or not the Fed can deliver a soft landing with the rate cuts we've seen throughout the year, and then some sort of a favorable resolution to China with a trade dispute with China. So those are the factors we have our eyes on. We think if those continue to drift positively, the market can go up, and if not, then maybe we see a few speed bumps.
On that note, Alan Bond with Jensen Quality Growth Fund. Thanks so much, Alan.
Thank you.
And coming up, ringing in the holidays with packed stores and crowded email inboxes.
Here's a look at what to watch for tomorrow. Dow component Nike will report its earnings. Investors will focus on its direct-to-consumer sales as well as its operations in China. We'll see what the existing home sales numbers say about inventory and demand. And the House is expected to vote on the new NAFTA agreement, now known as the USMCA. And that is what to watch for Thursday.
And finally tonight, is your email inbox overflowing? Chances are it is, and you're not alone. It's the season when retailers push out more and more promotions every day designed to get you to click and buy. Courtney Reagan has more now on this strategy that has some consumers saying, enough.
Your inbox is probably flooded with retail promotion emails this holiday season. Email remains the center of many digital marketing campaigns because it's controlled, inexpensive, permissioned in some way. And consumers say it's a preferred communication channel. Around $500 million will be spent on paid placements in email this year, a sliver of the digital ad market. But it's growing by double digits, according to eMarketer. The cost? A fraction of a cent. The return can be pretty valuable if you can get shoppers to take action. And more are clicking. From 2017 through last year, the percentage of shoppers that buy from a click increased from about 4% to 6.5%.
If there is some type of promotion or discount in the email, that can be a way to goose sales that would not have happened otherwise. It can also just be a way to bring sales forward to the present as opposed to sometime in the future. And of course, that is super important now for the holiday season.
On average, Bluecore's retail clients see 66 cents in revenue per email for price decrease alerts and $1.98 in revenue per email for cart abandonment notifications. A recent Alex Partners survey shows consumers are just slightly more influenced by email promotions than catalogs for holiday spending.
It does feel like my email inbox really heats up right around the middle of November. Email still boils up to the top as a very effective and measurable means of reaching your customers. And today, most retailers are looking to be as efficient as possible with their marketing, which is why, again, I think you see a lot of retailers reverting back to the tried and true email marketing messaging, especially this time of year.
But more than 1/3 of consumers do think the frequency of emails from retailers is too much. Whether these digital ads actually click with consumers and their checkout carts will be watched closely by retailers this holiday season. For Nightly Business Report, I'm Courtney Reagan.
Here's a look at the numbers from Wall Street today. The Dow fell 27, the Nasdaq was up 4, closing at a record. S&P 500 was down 1. And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.